Good morning, ladies and gentlemen. Well, by my calculations, the risk-dial is very neutral, and we will have a look at why that is. And we will have a look at also what's happened since the last Fed meeting and the last CPI. This week is unusual insofar as we get the CPI before the Fed meeting. And let's examine what has happened and what is likely to happen in the week ahead. What is important to understand is that since the last Fed meeting, which was on, Wednesday, the 2nd of November, this is the 3-month bill, it hasn't moved at all. In fact, it's moved up in yields very, very slightly, something like 15 basis points. So you can't say that the bond market is giving any kind of a green light to lower rates. This is the 1 year, and we are exactly where we were when the last Fed meeting happened. The movement is, and this is now the 2-year note, and we were here, so we are very slightly lower, 15 to 20 basis points lower in the twos. So all the movement has basically pivoted around the 1 year, 10-year. The 3 months are higher in yield, the 1 year is unchanged, and it's only the 2-year outwards which are lower in yield. But the 2-year very, very slightly, the 3-year slightly more. This is where we were, and we are now 30 basis points lower. And if we look at the 5s, then we are even more lower. But that is all the result of the CPI. Since CPI, the 5s really net are 20 basis points lower and looking to go up. The big move has been in the 30s. This is where we were for the Fed. This is the CPI, and everything since has been all concentrated in the 10s and 30s. Once you understand that, you understand that the whole movement has really been in the yield curve, which has pivoted around the 1 year area, and all the 10 years beyond 1 year have done significantly better. The further out, the better. And so once you realize it's all been the yield curve, you can actually say that it's the CPI here that's going to be critical rather than the Fed. The market is basically listening to what the Fed is saying, i.e. that there will be no rate cuts for a long time. That, to me, is the big fallacy. That is the untenable, the least likely outcome for the next year, i.e. that nothing happens in the short end. Something will happen in the short end, we just don't know when. And the signal is going to be given by the 3 months and the 1 year. When they start coming down, then the whole yield curve can shift lower. In fact, it's far more likely that the short end will come down a lot. And I'm talking about over 100 basis points in the course of a very, very few days. That's going to be the big movement. So now let's examine what the yield curve is saying and when something might happen. Now that we've established that the whole move for the past month has happened in the yield curve, let's have a look at what that is saying. This is the 3 month against the 10-year. Where were we when the Fed came out? We were here, and so basically let's call it 5 basis points, and we've gone all the way up to 85 basis points. So the 3 month, as you saw, did absolutely nothing. In fact, it's a couple of basis points higher, and all the move has been in the 10-year. If you have a look at what that has done to the monthly chart, it's taken us to the highest level that we've seen all the way back out to 2000. it's all a question of what the economy does now. If the economy finally rolls over, and there are precious few signs that that is going to happen, i.e. there is no unemployment is not moving higher the way it should, retail sales are not particularly weak, then it's a question of how far this can go and how far the Fed lets it go. Let's face it, the Fed is going to do 50 basis points. The big question is, how far is the Fed going to combat verbally the move that's happened in the longer tenures over the course of the past month? Does it suit them for the 10-year note and the 30-year note to be 40, 50, 60 basis points lower than they were when they last met? We have had CPI, which was a downward surprise. The question is, will it be a downward surprise again in December? And more importantly, going forward, will we go back towards the 2% Fed target rate? Mathematically, I find it very hard to see a too big figure sometime next year, but I don't think that a too big figure is important. What is important is the direction of travel, and at some stage the economy will have an accident, and that is when you see the big turnaround and the big move lower back down to 170 basis points in this yield curve. That to me is absolutely a given. It's always happened. It's happened in the 80s, it happened in the 90s, it happened in the 2000s, and then it happened again in 2007, and it happened again in December of in the middle of 2019. So to me, at some stage, this is an absolute given that the short end will far outperform the long end, and the yield curve will go back to at least flat, if not positive. It's just a question of when, and the when is going to be given to us by the 3-month and the 1 year rather than the tens. In any case, if we continue having a look at what is happening, and even in the 5s, 30s, you can see that on a monthly basis we're stuck. And if we have a look on a daily basis, I very much doubt that we can go beyond 42 again. To me, it's far more likely that at some stage this rolls over and comes back to these levels, to positive, and that can only happen if the Fed relinquishes the pressure on the short end. We could have a surprise by the Fed. They could not push back on what the longer end has done, but that to me is unlikely to happen in the short term. I think they would much rather have the short end too tight for a quarter or something like that and get 2 or 3 sets of really good figures on CPI. And that, I think, is going to be enough to make them turn and basically relinquish pressure and start not talking about rate hikes anymore, but actually the market can then start discounting rate cuts. Why would Powell push back hugely on what has happened over the course of the last month? After all, this is where we were, 235 on the 5-year forward inflation expectation rate, and we are now down at 222. So that is going in the right direction. If we look at the 10-year break-even rates, this is where we were, around the 250 area, and now where are we? 226. So we are 20 basis points, around 20 basis points lower in the 10-year break-even rate, and the term premium has absolutely collapsed. So fundamentally, there is no huge reason for him to push back hugely on this on these lower rates that we've had. He seems to be doing a very good job of anchoring the very short end, not having expectations move that much in the short end, and that tightness of the short end is beneficial for people switching into longer duration, because the inflation expectations are going down, they're not going up. So it all becomes a question of when he can relinquish this pressure on the short end. And he will only be able to relinquish that pressure on the short end when the data indicates that he can, or that he's either that he's over tightened, or that the economy is really beginning to give up. At some stage, that is almost bound to happen. The rate of change of the increase in rates is almost unprecedented. And also the fact that these inflation expectations are trending down, and in fact they've been trending down since April of this year, almost guarantees that at some stage we bust through the lows. I mean, if we look at a 5 year, if we now start breaking below this 219 area, we will be at the same level that we were back in 2017, 2018, 2019. If we go for a 10-year, we will be, you can see that we will be at the same in the same range where inflation was expectations were in 2013, 2014, 2015, and we had much, much lower short-term rates. So at some stage, where it takes a month or it takes 6, I have no idea, but at some stage the yield curve is just going to flip at an incredible rate. Right, now, so that we've seen what is most likely to happen in the longer term, let's have a look at what I think is likely to happen next week. All naturally depends on CPI, but if CPI is in line, I would expect the yield curve to, or rather the individual tenures, not to do very much, not even after Fed, unless the Fed says something incredible. To me, the 30-year here has shot its bolt. It is very unlikely, and I'm very pissed off that I didn't keep my position in the 30s. It is very unlikely that we can dip below this 345 level and stay below 345 unless the CPI is much better than forecast. I think it's far more likely that we now trade in a range between 345 and something like 380, 390, simply because the negative carry on this position for the next 6 months is going to be, ridiculously stupid. I don't understand why anybody would want to hold 30 years unless the rate of change of CPI going down is going to be much greater than the market expects, i.e. we start going down into the 2s. Because if we are only going to go into the 3s, I really don't see that the 30s are going to be the one that moves very much from here. I think it's far more likely that we trade back up to these levels around the 380 area than we are to break down and stay below 345. It just doesn't make sense what the market has done at the moment. It's just gone too far, too fast. To me, the 2-year note is the one that's absolutely going to be key. Unless it can break below these levels and start heading down towards 360, the market is still stuck. it will be the short end. It absolutely has to be the short end that leads from now on. Because if the short end is stuck at rates around the 450, 455 area, there is absolutely no way that the long end can do better. In fact, it has to do worse, simply because of the negative carry and the, too much expectation being built in for far too soon. And to me, the 3 month and the 1 year are the ones that will give me the timing. If we haven't had a single, close below this middle line of the Bollingers, that needs to turn. That to me says that we're still going to have quite some time of going sideways before we can start turning. I would have thought it's going to be late Q1 before we can start turning. And in the meantime, if we look at the 30s again, what I think is likely to happen is that we're likely to range between 345 and 395 as the short end finally stabilizes. And then when the short end goes, we can possibly come back down towards here. But the next big move has to be a move that flattens the yield curve. And when will that move that flattens the yield curve have started? Or when do we get an indication that it's starting? We'll get an indication that it's starting when 2s, 3s and 2s, 5s start flipping. You can see the big move that we had here in 2s, 3s. So basically what this means is that people are putting all their expectations of rate cuts not in the area of the 2s but in the area of the 3s, and this is the one thing that I got right. And if we look at 2s, 5s, you will see the same thing, that basically it's going up. But we are at very ridiculous levels, I mean very extreme levels that we haven't seen for many, many decades. So if we go back to 2s, 3s, what has to happen? This has to roll over and it has to start trading basically and closing below 22 basis points. So 3 basis points, and then you can start coming back down towards 10 basis points. But when will we know that it's the big move is starting? The big move will be starting when this is back to zero, when the market is saying that the odds of cuts coming in the 2-year area or within 3 years are more or less the same, are equal. So the 2s, 3s and the 2s, 5s, the more the 2s, 3s and the 2s, 5s, but both of them are to me going to give the timing. So it's the short end, it's the 3-month bill, it's the 1-year bill, and this spread between the 2 years and the 3 years. This is going to give you the indication of when the market starts really anticipating a turn. And looking at the very short end, which is going to give us the clue, you can see exactly what is happening, that the 23s are basically completely unchanged from where they were when the Fed and CPI happened. So this is H23, this is the candle of the CPI, and we are within a couple of basis points of it, and they are all just about, apart from Z23, the other side of 5%, i.e. they have the terminal rate above 5%, whether that's going to be 5.25, 5, whatever, these movements are going to be very rapid. And all the expectations are pushed out into 24 and 25. If we have a look, for example, M24, you can see this is where the Fed happened, this is CPI, and we are higher than CPI, so that you can see what has, exactly the same thing has happened in the very short end curve as has happened in the bond curve. This relationship has to flip for any lower interest rates to be sustainable, i.e. it has to be the 23s that lead the 24s. And that is only going to happen once the data comes in, which shows that the economy is giving up. Until then, the relationship is going to be either constant, or all the buying is going to be in the 24s and the 25s. But now, absolutely no selling can take place in the 23s. I mean, we are discounting here over 5% terminal rate. Yes. So where is the terminal rate going to go? Unless the economy reaccelerates, this is about as bad as they can go. And when things are as bad as they can be, normally the surprises are in the other direction, i.e. that these start leading because something bad has happened. While the US has been doing what it's been doing and what I've been describing, the German bonds have been doing nothing. This is the Schatz. It's just going sideways. It's waiting for the ECB, and I don't think it's going to do anything after ECB either. Fives, much the same story. They're within the same range as they were when, let's have a look where we were when the Fed came out, right here, and we are doing absolutely nothing. We are within 1 basis point or 2 basis points, and basically we are doing nothing, and we will continue to do nothing. The 10-year, it's tried to do a little bit better, but really it's 5-6 basis points better than it was. Nothing. So all the pressure is now actually on the differentials. If we look at what's happened to the French oats, nothing much. I was looking for this kind of level and it missed by a couple of basis points. It's in a range. I think we will see 247 again, possibly close this gap to 255, and then we will come back down again. I think that the movements in this are going to be minute from now on, and it's more likely than not that all the movements are going to be in the cross between, if we have a look, twos, differential coming down, fives, differential coming down, and the most important one, tens, it's also coming down but at a lesser rate. I think that it's probably going to take a while longer, but every time it goes up, this differential is a sell. I am almost convinced that at some stage next year we break this 152 differential and we go considerably lower. And when I say considerably lower, I'm talking about 140 first stop, and then around here, around 122. It's going to take some time, but that to me is the direction of travel. And that is going to happen when the easing has to start. It'll all happen at the same time. This differential will break and the yield curve will flip to positive all at the same time. I'm pretty much convinced of that. Tough to say what's going to happen to the US dollar, because my view are that those interest rates, as I just showed you, are going to come in at some stage, not now, but come in quite substantially over the course of the next, let's say, 6 months. Those interest rate differentials, I meant. So it's probably likely that we've seen a top in the dollar. I'm not convinced, though, that it's a sell here. I would not sell it until 106.25, simply because I see no reason for it to start coming off now. I think the Fed is certainly not, unless the CPI figures are amazing, which I see no reason why they should be. the Fed is likely to not say anything different than it has been saying for the past couple of months, or do anything different, then the market has already discounted. And I don't see why that should lead to anything but a normalization, i.e., some retracement of this move to at least 106.25. Anything can happen, but I really don't see that we are in a technical position now to start moving much higher. We've rejected this 105.80 level a couple of times, and we just basically cannot make much headway until we get some news. To me, it's far more likely that we test the low 102s or the 103s rather than keep on powering ahead. I see no reason for it. I might be wrong, but to me, the dollar is not something that one should be trading. It's far more likely that you're going to make money trading bonds than trading dollars. It's tough to say what's going to happen to gold, because if I'm right and TLT or the longer end backs up, then it's more likely to test 1764 than, break 1830. You can see that 1830 and 1764 are actually becoming very crucial. And if we enlarge this, we can see why. Well, 200-day moving average, 1830, and 1764, if we start breaking below it, we will certainly trade something like these levels, around the 1720 area before we bounce again. I think it's far more likely to test the downside than the upside, but this will probably give us the clue whether TLT is and the long end is likely to do better or not. I think the long end should do worse, certainly into Tuesday and the auction. Therefore, I'd expect the first short-term move in gold to be back down to at least these kind of levels, try to break the low around the 1770 area. So I don't have a position in gold. I'm watching it. I'm puzzled by its behavior at the moment. Starts breaking above 1830. It's likely to be a signal that the bonds are going to do better, and I don't know why they would. To me, bonds are extremely overbought and they need to come back, and so is the dollar. And therefore, I think the first move is likely to be down towards 1764. DBC, another close below 24.39. I think next week is going to be critical to see if we can regain 24.39. Let's see. I think it's far more likely over the course of some time to trend down towards this 22.91 level. And if we have a look at the relationship between gold and DBC, this kind of level should be the next kind of level that we look for, i.e. 744. It might take some time, but what is important to me is that this relationship is slowly turning. And that to me would indicate that the inflationary pressure is going to abate, and that to me indicates that the yield curve eventually flips to positive. And when it does, then we are going to see these kind of levels, i.e. 861. To me, gold is at the moment is saying it might retest lower and retest this breakout point and then go again. But over the course of time, to me, this chart is saying that gold is going to outperform DBC. And if we look at the oil price, which basically has such a large weight in DBC, we finally we're closing the month. I mean, the month is still young, but we are closing it below 75.16, and that would indicate these kind of levels are going to get tested around the 64 area. You can see the highs and the lows here. That is another sign of demand destruction, and that is why I think at some stage the economy has to flip. We have, the supply side is certainly constrained, and if the price is going down, that means the demand side is being constrained more. On the dailies, you're finally turning the 200-day moving average. If you have a look here, on the hourlies, you are a long way away from a very much downtrending 200 period moving average. Every spike gets sold. That to me indicates that at some stage this economy just has to flip over. Is it going to be soon? Is it not going to be soon? Who can tell? But that is what the market to me is saying, that at some stage the economy flips over because of demand destruction. And if that happens, then the yield curve has to flip to positive, and the big move has to be at the short end rather than the long end. What is interesting is that both gold and copper are at the 200-day moving average. It's coming down much more in copper than it is in gold, i.e. the slope of it is much stronger. I would expect next week to see, if copper can actually break this 374 level on the downside, and that to me will be a big sign of weakness. And then what should happen is that slowly gold copper starts breaking upwards and leading yields lower, and that will be another sign of the yield curve flipping, that it's beginning to be time to look at the shorter end of the yield curve. It might take some time. It might take several weeks or even a quarter or two. But I would have thought that eventually gold copper is going to start breaking upwards because of demand destruction and the economy turning over. And that to me is going to be the time when the yield curve flips. We will see. It's all, it's all getting to a stage where it's becoming unsustainable for very much longer. Can it last another quarter? Can it last another two? Yes. But at some stage, you just know that these big moves are going to happen. Last week in equities, basically, it was all in the sign of SPY TLT, i.e. people selling equities and buying bonds. We had a bit of a correction towards the end of the week when bonds went down much more than equities, but I don't think it's it's anything significant yet. We will, this again should lead us, and much more than SPY TLT, we have to look at the totality of the bond market against the totality of the stock market, and that's ITOT over government. That is the one that is, this is where we started the year, and we were here, we were very close to it only a week ago, and last week it just completely fell out of bed. It hasn't broken any level yet, but I would have thought that unless we can start rallying above 386 next week, that the Santa rally is likely to be abandoned, and that is going to be very unlikely, that unless bonds do incredibly better, which I don't see why they should in the short term, we are likely to actually not be able to do much better in equities either. At best, we're going to be stable. and at worst, we're going to come down towards these levels and close the year down towards the lows. So that, to me, is another sign of demand destruction, and that eventually the equities, even relative to bonds, do worse. I don't think it's going to happen next week, but I think the trend at the moment is the one that we're looking for the next shoe to drop, and the next shoe to drop has to be earnings rather than multiples. The Blue Angels are saying not yet, because you can see that we've started trending up in the earnings, even though a lot of people have reduced their expectations for next year to, let's call it 200 on average. I just don't see that we're going to see that move in the next few weeks, because this would have to start coming down quite substantially. It's much more likely that we remain, to me, times 18, no way do we cross times 18 unless the bond market starts doing incredibly better. And as I've told you, I see absolutely no reason for that. It has to be led by the short end, and a move by the short end now implies actually demand destruction and a weaker stock market. So I think it's much more likely that we bounce around next week, probably quite violently, but any move up to this 41 something is a big sell, and anything below 3800, and we will see the levels in detail, is likely to be very much resisted. So I think it's still a trading range in equities, and that's what the fundamentals are saying. If we look at a clean chart, you can see how important 39, 34 is, and we just keep on being attracted to it and not being able to break down. If I enlarge that, every time we break below it, we go, quite a bit lower. I mean, this is the least that we went, which was 38.80s, so that's 50 points. To me, we are probably likely to fill this gap and try to trade down to 38.26. That would be nice. I don't think it goes much lower than that. To me, I couldn't sell it here. I sold a few calls when it went up, but because these levels around the 41 20s something, 41.25, are very unlikely to be broken, simply because of the multiples and simply because of the switch between bonds and equities. To me, this is very unlikely to be broken. So that is very much likely to be a top, with the bottom of the trading range somewhere around 38.26, unless the Fed says something incredible, which I don't think it will, because it has no reason. As I showed you earlier, the inflation expectations are trending down. The CPI is trending down. There will be no surprise more than a 50 basis points hike. So why would they resist very much what the market has been doing in the past few weeks? I really don't see the reason for it. But we will wait and see. It's all in the sign of do we expect the switching from bonds from equities into bonds to accelerate? Well, it would only accelerate if the data says it needs to, and at the moment I'm not seeing any data that it's saying that it needs to accelerate. Some rebalancing that we've had in the past week between bonds and equities was not all that unexpected to me, but much more than that, something that takes us far below 38.26, I think it's unlikely as well. The Dow, which is a much more defensive index, it's far outperforming SPX. And the 200-day moving average has actually started trending upwards. To me, the key is going to be this 32,500 and odd level. If we can't break that on the downside, I think the S&Ps are very unlikely to do any worse than that gap I just showed you. And that, 38 odd level. And after that, we could have, quite a sizable bounce. Unless the defensives can break down below this level, I really don't see that the S&Ps should break either. And it's much more likely that we remain in a range rather than not. It's also important that you should understand how far SPY over FEZ, which is Europe, all in constant dollars, has come down. This has been a massive move, 1180 down to just below 10. So that's over 10%. And we are at levels that were support, or very close to levels that were support in the past, back in 2020 and 2021. So unless this starts breaking quite hard, it would imply that SPY can't really go down that much unless the European market follows it, i.e. unless they trade in tandem. So if we look at the European markets, we are really not, sorry, that's the wrong page. We are really not seeing a lot of bad patterns there. We have support underneath at 38.82, and that would probably equate to what I just showed you, that we can possibly go into the mid to low 3800s, and this trades down to 38.82, and unless this starts breaking, then the S&P is unlikely to break, and also unless the Dow breaks those levels that I showed you, it makes it all very unlikely that the stock market can start breaking down hard now. I think that the stock market breaking down, if it is going to break down, is going to be late Q1, early Q2 story, and that is when the yield curve flips. But we will see. I still am not an active seller of equities because I see no reason to be an active seller. I think we will get better opportunities next year to sell equities rather than now. If we have a look at volatility, actually it's left another gap down here now, hasn't it? Down to 1910. It's funny. I think what could possibly happen is that we go up to the 25s, possibly to the 26s, and then collapse down to 19, which would marry up with that idea that the S&Ps go down to the mid to low 3800s. The European market gets to those levels that I just showed you of support. The Dow does not break that level that I showed you. It tests it, and then volatility, from the 25, 26 area comes back down and fills the gap down to 19. Could very well be what is in store for the next couple of weeks. We will see after the Fed. It's going to be fascinating to see what the market does after the Fed. Personally, I don't think it does very much. I think the long end just cannot do better while the very short end is completely anchored. I was surprised that it got as far as it did, but I think it's much more likely to back up a little bit rather than keep on going. I've updated all the levels. I think we're far more likely to test these upper levels than not next week, and for the yield curve to disinvert slightly. And after that, we see. I really don't think that we are at the start of a big move either way in the bond market. I think we are much more likely to back and fill for the next several weeks, which makes the equities still range bound. And I've showed you the levels and I've showed you why. And I really don't think, I mean, 38.26, unless the defensive sectors of Europe and the Dow are breaking the levels I showed you, I think is going to be a great opportunity for a 150 point bounce easy into year end. I really don't see that we are at that stage where the equities break down as yet. Thank you very much indeed, and I will tweet you on Monday.